Hey folks, Alex here, 95 to Freedom. In today's video, we're going to talk all about margin. What is margin? What is margin maintenance? What is buffer or surplus, house, exchange, all these types of terms that you probably have seen floating around. So I wanted to answer some of the questions I've been getting in the comments, so I figured I would just make a video about it. And before we get started, just wanted to say a huge shout out to all my new subscribers, folks. We are almost at 2,000 subscribers, which is just insane. I started this channel beginning in January of this year, and I really had under 100 subscribers until the last month. So this channel has been growing, which is all thanks to you guys. All right, so let's talk about what is margin. And yeah, so folks, real quick here, I'll just go to my portfolio for those folks who are new. This is the portfolio that I have. Okay, these are high yield dividend paying ETFs that I'm holding. Don't worry about the 3 items on the bottom. These are just some options that I'm doing, but focus on the 5 items on the top. Okay, so I'm holding a very large position in Alti, which is from YieldMax. I'm holding a position in QDT from Roundhill, XDT from Roundhill, BTCI from Neos, and SMCY from YieldMax. So these are the 5 ETFs that I'm currently holding. As you can see here, their value is listed in this column here, current value. And this is the amount of shares that I'm holding right here. All right, so if you look on the bottom of the screen, you can see there's 2 numbers here. The one on the very bottom in the bold is 200, and I'll just zoom in here a little bit. $201,882. Okay, this is my own money that is in this account. Now we are using margin, so that means we are borrowing the money from Fidelity, which is my broker, and investing into these funds. And that money represents $111,892. Okay, so that's what I have on margin. So if you calculate both of these numbers, if you say 111,892 plus 201,882, $313,774 is what represents my portfolio. So all of these funds that I've purchased is the total of $313,774. Okay. Now, what is margin? Well, margin, again, it's this debit, the negative number, 111,000. Now, why would I use margin, right? Isn't that risky? Well, think about when you buy a house. Most people, unless you have a lot of money, most people go out and they'll put a deposit. They'll say, let's say we do a 20% deposit, 10%, or if you're going through some FHA program, maybe you can do like a 5, a 3. Some folks like veterans might get like a 0% deposit, right? And the rest you would finance for the course of, let's say, 15, 30, 20 years, whatever you choose. And then you're making those payments, you're paying the interest and all that kind of stuff, right? Now, it's a very similar concept. Basically, you're leveraging the money. You, instead of, let's say, you waiting, I don't know, 15, 20 years to save up for a house, you were able to move into that house and get to enjoy and live in it as long as you can afford it. So there's also lots of different, metrics that we use. Like we don't want our payment to be more than a quarter of our income, all this kind of stuff that people do in order to be able to afford their house. Very similar concept is in the investment world. Basically, the brokers are out there and they have lots of money that's just sitting out there. And they, they hang like a carrot in front of us and they're like, hey, why don't you use our money and you be able to grow your portfolio? Now, there's obviously a plus side and a negative side, and we're going to cover both of them. So the plus side is you're able to grow your portfolio much faster. I think back to when I was investing in real estate. I would put let's say a 20% down, and then I would borrow the 80%. Now, 5 years goes by, the value of my house grows, that mortgage gets paid down, I'm getting cash flow from my rentals. So all those things are beneficial to me by me leveraging. And the same concept is in using margin. Margin is basically a loan. Now, the way that it typically works is you'll have a set interest rate that you'll be paying. And that's all you're going to be paying. You're going to be paying the interest rate unless you deposit more money into it. So when we If you watch my video, How to Live Out of a Brokerage Account, I cover this. Basically, when you're getting that dividend, the margin amount drops by the dividend amount. But regardless, you still owe the interest. So many folks who are starting out into margin, a lot of folks go to Robinhood for this reason, because I think Robinhood is offering like 5.5 to 5.75% on their margin, which is very, very low. I mean, you can't get a mortgage for that low of interest rate. Now, I'm with Fidelity. I stuck with Fidelity because my 401k is in it, my IRA is in it. I've trusted them. They've been around the block for a while, and I negotiated my rate down to 6.375%. Now, a lot of folks who start out with Fidelity, they're usually floating around 12%. And I have a video actually that you can check out where I talk about how I negotiated that rate down. So with the 6.375%, basically that's what I will be paying in interest on this loan amount. So a really quick calculation would be to take 111,892.95, okay? And we say times 0.06375. That is my interest rate. So I am paying $7,133 to Fidelity every year for holding this margin. Now, this margin adjusts. Sometimes I pay some of it down, sometimes I use some of it. But on average, let's say if we divide that by 12, that's going to cost me about $594 a month to leverage this money. Now, is this risky? And, obviously the plus side. The plus side is folks like something like QDT, XDT, these funds, they pay around 30 to 35% in dividend per year. So this is arbitraging, right? You are saying that if I can make 35% on these two funds and I owe Fidelity, let's say 6%, I'm making the 29% difference, as long as these funds obviously keep up with and they don't sink down, or their whatever they're paying out doesn't go down. Now, funds like Alti, okay, I've made lots of videos on Alti. I have the largest positions in Alti. This fund pays around 85% per year, which is just bananas. So why not utilize that, right? Now, that is the plus side, right? You are able to leverage the money to put it to work. Think of it also like starting a business. Let's say you want to start a business, but you need capital to get started. So you're going to borrow money in order to start this business, to have the capital to do whatever you're trying to do, and then you're going to pay down as times goes by. So you're able to get a head start at it. The dangers of it, folks, is in a large market correction, or if you're spread around very volatile, very single type of stocks that have the tendency to maybe drop like 20, 10, 30, or 50% in a day, then you could get yourself in big trouble, because this money, no matter what happens to the valuation of your stocks, this is what you'll always owe to your broker, right? So if let's say on Monday the market opens up 50% down, if the market opens up 50% down, then what does that mean? Well, my account is going to go in half. Okay, so if you say right now, what do we say? 201 plus 111, right? So right now we're roughly around 300. What is $313,000, right? So if the market crashes 50% on Monday, that means the value of this portfolio is now going to be $156,000. And that means that I still have to pay the broker what I borrowed, which was $111,892. So I would have to subtract that, and this is what I would still owe them. So all I would have left in my portfolio would be $44,000 of my own money. And that is the risk, folks. Okay, so this is the reality. There's always risk and reward, and you want to find your happy medium, how much you're willing to risk in order to get that reward, and trying to figure that out. Now, none of this, what I'm telling you, is advice. So you do your own research, you study what you need to do, reach out to financial advisors. I'm just showing you what I'm doing. Okay, so right now I feel pretty confident holding the margin that I'm holding. And I had folks that would leave comments like, you're crazy, why you have so much on margin. Some folks would say that margin is bad. This is how you lose everything. Now, this account here, just for the record, this represents probably the most risky part of my whole net worth. Okay, so I hold real estate, I have rental properties, I have my 401k, my IRAs, all that stuff is very diverse, very I would call very safe investments. Now this stuff is my risky portion of my portfolio, so I'm willing to be a little bit more risky in this. If all of your eggs in one basket, then you have to evaluate, do you want to risk that much on it? Okay, so that is the downside of using margin, right? So in a huge correction like that. Now, what are the chances of a large correction like that? I'm not going to get into the statistics, but we've had corrections in the past. If we just look at, we'll just say total market index. Okay, so let's say we'll look at the maximum time frame. Okay, thinking back, this year, right? We had a correction back in March into April. This is when the tariffs were announced. Now we got out of this really quickly. We've had a quick recovery. We've also had very slow corrections. Okay, so like the downturn that we had back in 2021. Okay, we've dropped quite a bit. It was a very down year. And then we had the COVID, right? COVID happened back in 2020, and then that was another case of a fast recovery. We can go back to like 2008. Let's see how far back this can go. Anyways, I don't want to get into the weeds, but we've seen corrections in the most recent by like 10%, maybe even 15%, depending on what you're holding. So there is a chance of that. Is there a chance of a 50% correction? I'm sure there's still a chance, but what is the chance of it? I don't have that number, but that's just something you have to kind of keep in mind. All right, so that is margin. That is how you use margin. So basically, to start with margin, you just go to your broker and there'll be a link where you would click, okay, enable margin. There'll be a questionnaire. Have you ever used margin? How comfortable you are with margin? You can also call them. They can help you set it up, all that kind of good stuff. Okay, so that is the pros and the cons, right? Now let's talk about what is margin maintenance. I mean, there's folks out there who are selling ebooks, e-guides. They're trying to sell you a course and all this stuff. I give everything away just like I received it. Okay, maybe I've even paid for something, but I'm here to give, guys. I'm not here to sell you anything. There's lots of people making money off of people. I just want to share what I know, and what you do with it is your own decision. Let's talk about margin maintenance. Now in Fidelity, to look at margin maintenance, you go to balances, and then you go all the way down and you get a breakdown right here. Okay, and we'll just talk about this right here. So we'll start from the top. This is intraday buying power. So this is what basically Fidelity is letting me day trade with. Okay, let's go down here. Right here. This is the important stuff. Margin status. All right, so net house surplus. This is what I want to talk about. This is the surplus that I have. This is the buffer. So it can be referred as to surplus and as to buffer on my margin. Okay, so before I get any margin calls, before anything happens, I have to eat up through $62,000. So basically, I have to lose $62,000 before I get a margin call. Okay, and the net exchange surplus, this is like set up by the stock exchange. Okay, as you can see, that the value is double that. Now, it doesn't matter what this one is. What matters is the lower one. Okay, this is the one that your broker is going to margin call you on. So that is my buffer. You can see my margin interest rate, 6.375% right here. And you can see my margin interest occurred daily, $18.71. Okay, margin market value. Again, this is what I have in market value. And this is what I have on margin. Now, if you click on the calculator, okay, this screen will pop up. And you can, in the calculator, you can fill in the different types of funds if you want to mix up the portfolio. But really what I want to show you here, And let me see if I can enlarge this. This is the margin maintenance requirements of the funds, and that is what's really driving that surplus. Okay, QDT, one of the funds that I'm holding, this has a 30% margin maintenance. So what does margin maintenance mean? It means that I need to have 30% of my own cash. So my skin in the game needs to be 30% at the bare minimum, or I will get a margin call. So think of it as when you're buying a house, your minimum deposit would have to be 30%. Now, if the value of that drops and I'm in, let's say, 25%, then I'm at risk of a margin call. Okay? So I hold a $64,000 position in QDT. I need to have at least $19,000 of my own money in it. And this is why something that has lower margin maintenance is less risky. Okay? And typically the broker will set the margin maintenance. You will not typically see it below 30%. That will be the bare minimum. You got to have at least 30% skin in the game. Okay, think about it this way. If all I had was QDT in here, that means that this broker, let's say if I had $100,000 of my own money in it, the broker is saying that I can borrow the 70% portion of it. Okay, so if we divide that by, let's see, 0.3, right? So that would be 300 and, am I doing my math correct? So 333 times 0.7 plus 100. Yeah, that sounds about right. Okay, so that means that $233,000 I would be able to margin. Now, again, if it drops down, I'm at risk of getting a margin call. Now, another position here I have is SMCY. This one is a 40%. So I have $4,800 invested into this one, and I have to have at least $1,900 of my own money in the account before I get a margin call. Now, Alti is my largest position, and this one has a 50% margin maintenance. Okay, so I have $200,000 invested in it. I need to have at least $100,000 of my own money in it. And basically that's how you calculate margin maintenance, okay? So again, the lower the maintenance, the more margin you can have, okay? The higher. Now there's funds out there that are 100%, which basically means they're non-marginable at that point. Okay, you got to have 100% of your own money in there. Okay, so yeah, that's really what you got going on here. No, I'm sorry. 100% would be 1-to-1. So you'd have to have the same amount of money invested as you have on margin. So if Alti was 100%, then I would have to have $200,000 basically in Alti, and they would be $200,000 on margin. Some stuff is non-marginable. Okay, so that is really the bread and butter of what margin maintenance is. I hope this is clear, and we'll just go back to this other screen. As you can see here, my buffer net house surplus is $62,000. Now, if I wanted to increase this buffer, some things I could do is I can lower my position in like XDT or QDT, which have a lower margin maintenance of 30%, and reduce my margin on Alti in order to have a larger surplus. Now, I'm getting much higher dividend from Alti, and that's one of the reasons that I'd prefer to keep it as it is right now. So that is my buffer. That is my what I have on margin, and that is my total market value of the whole account. I hope this is very clear. If you guys have further questions, if I missed something, please leave a comment below. But I just wanted to have a very in-depth, and I didn't mean to make this video this long, but that was what I wanted to talk about today. So hopefully you guys enjoy this. If you did, folks, I have a lot of you who are returning and watching my stuff. I would really appreciate a subscribe if you like this channel. This will help me grow it and be able to put out more great content for you. Everybody enjoy your Sunday, and we'll see you tomorrow.